what this means for the lineup of Fed governors, what this means for the path of the dollar. Is there a case actually for a cut in September? Bill Lee is with us right now, Milken Institute Chief Economist and Executive Director, is with us right now. Bill, good morning from the Asia Pacific. Thank you so much, and I know we dragged you into the show very last minute, so appreciate the time, sir. You were formerly at the Fed. What do you think is going on as far as Fed staffers are concerned now?
Well, the surprising part of the story is that Lisa Cook herself didn't resign. The history of the Fed staff and all the governors and presidents who have served at the Fed Reserve as on the FOMC have always been held to a very high standard. We're all told you cannot do anything that would even look or smell of something wrong, regardless of whether it is wrong or not. We have examples, for example, with Rich Clarida, the former vice chair of the Fed, who resigned because he was doing some portfolio adjustments that were pre-programmed. That is, he already told everybody he was going to do it. And apparently the disclosure wasn't complete. He omitted one or two transactions. And that was enough to cause some sense of uncertainty about whether he was doing something wrong. And he voluntarily resigned. Robert Kaplan also has some stock transactions that he didn't fully disclose. And there again, he resigned. There was nothing wrong with anything these guys did. But nevertheless, anything that besmirches or potentially besmirches the reputation of the Federal Reserve and its integrity of the staff is something that the staff takes very seriously. And they all tend to fall on the knife rather than to cause any kind of harm to the Fed's reputation. And Eric Rosengren, the Boston Fed president, also had some real estate transactions that supposedly were behind his retiring. So there are lots of examples of very high-profile individuals that themselves took upon themselves to resign rather than to bring any hint of scandal to the Fed.
Sure, Bill, but what's the intention with what the president is doing? Do you think that it's in some ways Trump trying to control the Fed? And it seems like those concerns are really kind of bubbling up now.
Well, I think President Trump has always been concerned that the Federal Reserve just is not lowering interest rates quickly enough, although he also probably knows that it's the long-term rates that matter, and the deficit has more of an influence on the long-term rates than the Fed does. But nevertheless, the general atmosphere of lowering rates is something that he wanted to put in place, and the FOMC wanted to put in place. The issue is timing. But right now, with all of the commotions of Chair Powell being too late, Chair Powell already put that aside by saying we're ready to move. So there's really no reason for President Trump to just fire Lisa Cook just to get his way by appointing more members of the FOMC that are more dovish than hawkish. So I think this particular case of Lisa Cook really surrounds the integrity of the Fed's staff reputation and the Fed governors being squeakier clean than clean kind of atmosphere that he apparently wants to maintain.
Right. So, Bill, let's follow that specific sort of thought exercise now. Do you think there is a case to cut, not just once, by the way, to cut successive times?
Oh, David, I mean, I've been saying that we could easily go 50 basis points at the last meeting. And the Fed's new operating procedures, right, for the next 5 years, the new policy framework, they were very clear to say that inflation expectations are the most important thing to maintain and to anchor. And we will let inflation as reported go up, say because of tariffs, or we can let the unemployment rate go up because we recognize that circumstances change what is normally considered the equilibrium level of unemployment. The natural rate has always been like between 4 and 4.5%. But Chair Powell said because of the changes in immigration laws and the changes in the productivity of labor and the demand for labor, the demand and supply are highly uncertain right now. So he's looking at a whole bunch of indicators. And that's what's going to make Fed watchers a very hard job going into the future because the new policy framework gives the Fed a lot of flexibility. They got rid of the average inflation targeting regime, which is, will keep things higher than average. If things are below average, if they were above average, you have to keep these lower. And that's kind of a wishy-washy kind of way, which always was doomed to failure. And now they're much more specific. They say, look, we have full employment and price stability, and we're going to get there. And we're going to do whatever it takes to get there.
On inflation, though, what we heard from Jay Powell at Jackson Hole was that it might be it's not all at once, right? Because given what we've been seeing with tariffs and the like, that this looks like it to be something that is very slow moving, but maybe more persistent. Does that in any way change how they look at whether or not to cut interest rates or not? Because right now it seems like we're not seeing the data, but it could be something that comes in waves.
The key is to keep an eye on those inflation expectations, and not just surveys, but the break-evens as measured in the financial markets. If those start to rise, then that will cause concern. But even if we have waves of tariff-related price increases, Chair Powell has made the brave move of saying, once again, I think those are going to be transitory. and we're willing to move policy in advance of what we see developing with tariffs, because we're concerned about the labor market weakening, even though the unemployment rate itself isn't moving. So that's an example of the new framework at work that gives the chair and the FOMC more flexibility to make the right decision, even if the traditional indicators are not all there. So I think, even though, as you say, the tariff price increases will take a while to kick in, he's convinced enough that it will not lead to a dislodging of inflation expectations. And that, again, is, you can get a daily reading of that or an hourly reading of that by looking at the break-evens in the Treasury market or the swaps, or however you want to calculate that.
Bill, do you think Jay Powell's job is safer now?
I think it's unlikely that he'll be firing Powell, because there's really no cause, and now there's no reason, because Powell already said we're ready to move. And if the next set of data on inflation are really hotter than what people expect, then it'll be 25 basis points. If it's cooler and we have some weak payroll numbers, it may well be a 50 basis point cut, which I would vote for if I were on the FOMC.
Right. Bill, just one last question for you, sir. If the jobs number comes in not extremely hot, but a solid jobs report, do you think there's a case for the Fed to hold? And do you think if the Fed holds, that in some way underscores their independence?
I think the one thing that we've learned now is you don't let any one data point push you around. You cannot make a decision based on one data point. Based on the data we have so far and the likely number that comes in at the beginning of the month, the Fed will move. So I think and given the lack of certainty and data revisions associated with payrolls, no one number is going to be decisive. And if it was incredibly hot, like 150,000, 200,000, I would tend to dismiss that more than anything else. If it was 20,000 or negative 20,000, I would tend to dismiss that too, because, again, the quality of the data are so poor, I cannot, and the Fed will never make a decision based on any one data point.
Bill, thank you. Bill Lee there, Milken Institute's chief economist and executive director, joining us from Henderson, Nevada there. Coming up, Fortescue CEO Dino Otranto